I watched Powell's speech, and it was really amazing because in December, he was extremely hawkish. And he was basically like, listen, we're going to keep rates higher than you like and longer than you want. And that was pretty clear, and the markets reacted. And then not but 35, 40 days later, he essentially said, we have 225 basis point hikes left to go. And he's going to try to stick the landing, essentially. And even though the rest of the language in his entire speech and the press conference, if you read it in the absence of his body language, so if you just read the transcript, would seem very hawkish as well. But the reality was he basically capitulated. And then the market essentially said, okay, we're at the end of this thing. And we've talked about this before, but markets tend to bottom 6 to 9 months before it's clear that you could have done this. And so we're a little bit off to the races in the short term. It's compounded by a couple of other factors. One is that at the end of last year, so many people were tax loss harvesting, which means if you had some gains somewhere else, you sold some things that were losing money so that you could net the two together. You saw a lot of stocks. Tesla was probably the poster child for this, trade all the way down to like $108 a share, and it's effectively doubled in the last 30 days, right? So everybody tax loss harvested, everybody degrossed, nobody was really owning anything. And then when Powell basically said, we're mostly done, there's been so much systematic buying right now that nobody's really well positioned. To me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated, again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher. Then we went into the COVID pandemic and all of that stuff happened. So I think we're about to replay a little bit of that. At least in the next 30 to 90 days, the pain trade is to go up. So that's probably where we're going.
Bitcoin lingered near $23,000 on February 7th as a key chart phenomenon hit for the first time in 18 months. Data from Cointelegraph Markets Pro and TradingView showed BTC/USD tracking sideways overnight, having shunned volatility at the week's first Wall Street open. While failing to flip $23,000 to support, the pair nonetheless saw a potentially significant event on February 6th in the form of a golden cross on the daily chart. This refers to the rising 50-period moving average crossing over the 200-period moving average. The last time that this occurred on daily time frames was in September 2021, 2 months before Bitcoin's latest all-time high. Hello and welcome to Crypto Street.
So we have a period now which is disinflationary. But the problem is, if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. You know, there's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, right? More money they can raise, more money as a result that they can spend, because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy and the second half of the year would be really robust and like you need it to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now.
Oh,
and
really?
So the big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, I think there's, again, the marginal risk will be that We do whipsaw, as Sachs.
Some crypto analysts have keenly watched the cross, with Venture Founder, a contributor to on-chain data platform CryptoQuant, arguing that $25,000 could reappear as a result. Bitcoin Golden Cross just happened. He summarized in a Twitter reaction, this potential correction could see BTC retest $20,000 to 100 DMA and key support. Then in the bullish case, test $25,000 next, make $25,000 support, and it's nail in the coffin for the bears.
The thing that we have to think about is like, most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index, those represent certain percentages. You have to own those percentages to be relevant as that index. And so it's this reinforced buying loop as well as a reinforced selling loop, right? So when things start moving, those folks have to just systematically move money in. All the humans know that. So the humans tend to front run all the computers, and they basically are the ones that sell into these guys. And then that's what inflates these prices. And similarly, on the way down, humans try to front run it by being short into that stuff. So we could see the capital markets open. Even if we don't, it's actually the worst scenario because now you have all this money going into a fewer number of names. That sort of explains Facebook has doubled in 30, 60 days.
Yeah, I was about to
Tesla,
get to that, yeah.
Tesla has doubled in 30, 60 days. A lot of the tech stocks, like high beta stocks that we are all, helping to build, those companies have just absolutely ripped 60 to 100%. These are not healthy and normal moves. And so the question is, what happens if inflation somehow all of a sudden pokes itself back up? If you listen to Buffett's teacher, this guy, Ben Graham, in Ben Graham's book, the way that he would look at a stock, and obviously, look, things have changed, but the way that he would look at a stock is he would look at that risk-free rate, he would double it, and then the inverse of that is the maximum price to earnings ratio that he would pay for a stock, right? That's the trade-off is if you can get more than 2 times the risk-free rate, then it's worth owning a company. What that means is that if you take 3.5% as a terminal rate, the right PE is around 14 for the S&P 500. Right now, the S&P 500 trades at 22 times PE, which would mean that we are 50% overvalued. Now that, again, that's a Benjamin Graham model, and I think the world has pretty cleanly moved away from it, but there's probably some rooting in that intellectual framework that's still valuable. And to your point, David, it just reinforces that, man, we need to start to learn a new regime here because when rates are not zero, there's just a lot of excess that you can't support because the alternative trade-offs for investors are plentiful, and plowing money into a money-losing startup becomes less attractive.
Ahead of next week's macroeconomic data prints, multiple Fed officials were set to speak, with Chair Jerome Powell's words expected to be the most significant regarding market-moving potential. Nothing special this week. The only key factor to watch is Powell tomorrow afternoon. Perhaps one more sweep for correction, and then the party should continue rallying upwards.
We did a little analysis over here, and it was just basically looking back 60 years of company formation. We looked at all of the 100 most valuable public company startups, and we indexed that to the 10-year interest rate.
So what are we looking at here, Chamath, with this chart?
So basically, we went back from 1960 onwards, so basically, 63 years. And what this shows you is the 100 most valuable public technology companies. Then the size of the circle here is their market cap. And then it's overlaid on top of the 10-year interest rate, as well as gray bars for recessions. So what is this graphic meant to illustrate? Well, it just was for us to study, is there a correlation between the value of companies and what the interest rates were or what the economy was doing at the time? And to your point, Jason, the trend is pretty starkly made on this chart, which is that if you are a company that was founded in a period of austerity, you had the ability in general to build a much larger company than that which was founded in a period of wealth and excess, right? So when you look at when rates were sort of approaching zero or were zero, there was a lot of really successful companies. They're listed here in the light gray on the right, But none of those things really represent the success that these other companies had. That's the first interesting takeaway. The second interesting takeaway, though, from this has nothing to do with rates per se, but it is that when rates intersect with the emergence of huge technology trends, so in the case of the 1970s, it was the PC revolution. In the case of the late 1990s, it was the internet revolution. Those two things, which required enormous progress in both physical infrastructure, so atoms, as well as software infrastructure, bits, when you put those two things together, those also created big companies. And so if you add that all up, the point is that whenever you see huge tectonic shifts in technology combined with periods of austerity, that's when the gargantuan dollars are made. So in the 1970s, companies like Microsoft and Apple from the get-go had to be profitable, right? And in the absence of one very important round of financing that Amazon was able to close, the next big wad of companies were founded again in rising rates where they just had to get profitable or find a way to be positive free cash flow or have positive working capital faster than anybody else. So these are like really interesting trends that I think just say that as rates creep back up, and if we can intersect that with some improvements in technology over the next 5 to 10 years that we've all talked about, it could be a real boon for startups and startup investing.
So, is it a good time to invest in crypto market? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.